counting down the days to RebelCon, and virtual passes are now available at an early bird discount of $200 off the normal ticket price. This virtual pass gets you live access to all general sessions with our expert keynote speakers, as well as links to view the sessions later. This deal will end soon, so get your RebelCon virtual passes now. Hit the QR code for more info or visit rebelcon.marketrebellion.com.
Hello, Market Rebels, and happy Monday, everyone. And we've definitely had better Mondays. Last I checked, the SPY was down about 2%, but it looked like it might be trying to rally going into the close. But about roughly 70% of the days, you're going to see plus or minus 1% for a change. So 2% is a pretty heavy day. But I did talk about it last week where we were bouncing off, at least for the SPY, the 200-day moving average. And so that's not uncommon to see it retreat. But we'll have to certainly keep an eye on that throughout the week. For today, we are going to continue with synthetics. I talked about that last week. That was our synthetics week. And then I mentioned that we are going to spill over into this week. So it's going to be today and Thursday. We will be talking about synthetics. Friday, I'm going to talk about a related topic. It will certainly help you to understand synthetics, but this is pretty much going to be it for today and Thursday. But that doesn't mean that's where synthetics stop. It's a really in-depth topic, super important for traders, and that's why we're talking about it. But if you remember from Friday, I left the group with a little question, and I said that we can see where two different portfolios, two synthetic versions, don't necessarily match up. And I said, why is that? And so that's what we're going to answer today. And the answer comes down to the difference between what's called a replicating portfolio versus a mimicking. And a lot of traders don't know this. When we talk about synthetics, generally in trading, we are talking about a mimicking portfolio. But in the world of options pricing, it's really the replicating. And that's why we end up with this discrepancy. So here was kind of the question that we looked at on Friday. And let's say that we're looking at a call option on the left and the synthetic counterpart on the right, stock plus put, and they look alike. Stock plus put is a synthetic equivalent. Looks, acts, feels, behaves just like a call option. But if you look at the prices from what we talked about last Monday, we saw that the call was 438 and the stock and put was a total of 52. And that's why some traders go, wait a second, why would you call these synthetically equivalent when the prices are so off? And that's a super, super good question. And that's what we're going to talk about today. So the thing to understand is that we really have two different synthetic formulas. There's one, again, that's called a replicating formula and one that is a mimicking formula. Now, going back to last Monday, I showed the intuition behind the put call parity formula. And I said that we made this example up where you were trying to buy 10 of these $50 one-year calls. And what were they worth? That's what we were trying to figure out. And in doing so, we figured out the intuition behind the Black-Scholes model and the option pricing. So in order for the market maker to fill your order here, so remember, you're the one buying these calls. I said the market maker had to sell the calls. He's taking the opposite side of the trade, and that gave him this risk profile, unlimited upside. Well, of course, very few people are going to want to take that. So to counter that risk, the market maker might go out and buy 1,000 shares of stock. Well, it's a good move, but unfortunately, all it did is it reversed the deltas. That's part of the whole put call parity. We're just taking the calls, and if we hedge that with short shares, we end up with a short put. Well, now to block off this unlimited downside, the market maker might go out and buy the $50 puts. And then we found out that flattened everything. It made it behave like a bond. And that's kind of a weird thing. And again, this is the intuition behind the Black-Scholes model. If we can neutralize the risk, we don't have to worry about what risk we should be pricing in for the options, because they're certainly not risk-free. And Black and Scholes said, well, hey, if we could neutralize it at every step of the way, we don't need to know what the risky rate is for the interest. We can just neutralize it. So notice right here what's happened is that the $50 puts that are long and the short $50 calls up here is a what? Synthetic short stock position combined with the long shares right here flattens it. You're long and short 1,000 shares of stock mathematically, and that's what's causing this line to flatten out. That's what's making it behave like a bond or like a T-bill. So if you think about a treasury bill, you buy it at a discount and it matures to the face value. So I said in Monday's class that this three-sided position has a special name called a conversion. So the market maker ended up being long shares of stock, long a $50 put, and short the 50 call. So that was, in the example, we said that he paid $50 for the stock, he paid $2 for the put, and we found out that the call should be worth $4.38. And again, that was going to behave just like a bond. So we found out that if the market maker is guaranteed to receive $50,000, what's that worth? Well, if interest rates are 5%, which is what we assumed, we said the package today had to be worth $50,000. That's the maturity value in a year divided by the interest rate, or 1 plus the interest rate. It should be worth $47,619. And the way that we checked that is we took the $47,619 times 1 plus the interest rate. There's our $50,000. So we figured out that this position must be worth $47,619, and yet the market maker had spent $52,000. So how would he bring that price down to $47,619? And that's where we said he would have to make up the difference by selling the calls for $4.38. All right, so again, you can think of this as a guaranteed cash position that is maturing to $50,000. So this brings us now to put call parity formula number 1, what we might call a replicating portfolio. Let's look at stock plus put minus call equals a bond. Using our numbers, we had a $50 stock, $2 put, $4.38 that he received from selling the calls. That's why it's a minus sign. And there's your $47, roughly $619, $47.62. And so that's behaving very much like a bond. So let's say that we go, okay, well, now that we've got this formula, what's a synthetic call? Well, to solve for the call, we have to get it by itself. We find out that the stock plus put, that's the left-hand side, equals a call plus a bond. See, this is what we don't see in the typical formula, but we do in the replicating formula. And so we would have to buy this bond. All right, so take a look now. If the market maker spends $50 for the stock and $2 for the put, and let's say that we buy the call for $4.38 and we buy this bond for $47.62. Remember, that's today's price. It's going to mature to $50, but today it's worth $47.62. And if that's true, now look at that. 52 equals 52. They do balance. Everything balances. Okay, so in a case like this, the portfolio values would balance and the changes would balance. So what do I mean by that? Well, again, let's say that maybe you buy the stock and the put, the left-hand side, for 52. I buy the call and the bond for 52. Our portfolios will balance every step of the way. No matter what your portfolio is worth, mine will be worth exactly the same, no matter what happens to that stock. That's what we mean by the portfolio values will be the same. And the changes will also be the same. So that means if you're up $100, I'm going to be up 100. If you're down $275, I'm going to be down $275. All right, so we will have the same portfolio values and we'll have the same changes. That's why it's called a replicating portfolio. Everything is exactly the same. So for instance, let's say that we have the stock at 50, the $50 put is worth 0. All right, so if you've got the stock plus put portfolio, you've got shares worth 50 or puts worth 0 at expiration. What's my call worth? Is worth 0. What's my bond worth? Is worth 50. Notice at the left-hand side, 50 plus 0 equals 0 plus 50. What happens if the stock falls to 40? Well, you've lost 10, right? You had shares at 50, they've fallen to 40, but your put went up 10. So your total position is now worth 40 plus 10 or 50. What am I worth? 0 plus 50. I'm also worth 50. And the same is going to happen if the stock falls to 30. We are going to balance every step of the way. What if the stock goes up? Same thing. You're worth 60, I'm worth 60. Stock goes to 70. We are both worth the same every step of the way. What about the changes? Well, let's say when the stock falls from 50 to 40, you lost 10, but you also gained 10, which means that there was no change. Well, look at me. I went from 0 to 0. I had no change either. What about when the stock went from 40 to 30? Here you lost 10, but your put gained 10 for a net change of 0. I had no change. Okay, we're exactly the same. What if the stock goes up? You gain 10, your put goes out worthless. I gain 10 on the call. Stock goes from 60 to 70. You gain 10, put still worthless. I gain 10 as well. I go from 10 to 20. So that means that both of our portfolios will be absolutely identical in the values and the changes. That's provided you have the stock and the put, and I have the call plus the bond. That is the key. I have to go out and physically buy that bond. Well, now that brings us up to the put call parity formula number 2, which is the mimicking portfolio. So what does that mean? Well, what traders realized, they thought, okay, well, yeah, the true formula, let's call it, stock plus put minus call equals a bond. But why would we go out and buy the bond? Why should we go out and spend this money just so I can say that my portfolio value is the same as yours? Really, all I'm interested in is in the changes. If you're up 100, I want mine to be up 100 and so on. I want it to mimic it. I don't need it to exactly replicate it. And so because of that, we have a second formula where we say, you know what, just scrap the bond. Let's make it a different formula and say stock plus put minus call equals 0. And if we do that, now, if you bought the stock plus a put, you would spend 52. I would spend 438. See, now we don't balance. At least we don't balance in value, right? If we did this with 10 contracts or 1,000 shares, your portfolio, assuming this is the only positions we have in it, is worth 52,000. Mine's worth 4,380. That's hardly balancing, but the changes will balance. So again, that means that if you're up X amount, I'm up exactly the same amount. And if you're down a certain amount, I will be down exactly the same dollar amount. They will mimic each other, but they will not replicate each other. So this is where the confusion comes in. So it's this formula when we talk about synthetics in the trading world that we're using. We scrap the bond, and that's why the values don't match. So take a look at this. If you have the stock plus put and the stock goes from 50 to 40, you lost 10, put gained 10. What happened over here? That's a net change of 0 for you. I had a net change of 0 too. Stock goes to 30. You lost another 10, but you also gained another 10. Net change of 0. Look at my call. I'm at 0. Can't change anymore. I also have a change of 0. Stock goes up to 60. Okay, you've gained 10, but you've also have no change here, so you're up 10. What happened to my call? It's up 10. I've got the 50 call with the stock at 60 at expiration. It's worth 10. So I have a change of 10 going from 0 to 10. Stock goes to 70. You picked up 10. I picked up 10. I go from 10 to 20. But you can see that we don't balance. My position would be worth 2,000. Yours is worth 70,000. So that's where the confusion lies when traders say that there's something wrong with this put-call parity formula when we say that they are synthetically equivalent. And yet they say, but the total values don't match. And that's because we're using kind of a condensed version for the trading world because we're not worried about them balancing. We're just trying to make the changes mimic each other. So here's a really good example of using or where you can make good use of these formulas. We've often heard that naked puts are the same as a covered call. Well, let's take a look at these two formulas. If we have a replicating formula, stock minus a call, that's a covered call, equals a short put plus a bond. See, this is what most traders don't do. They just sell the put. So notice that if I sell the put and I collect 2, but I also have to go pay for the bond, what am I doing? I'm setting money aside in case I get assigned. So this is going to mature to 50. If I get assigned, I've got the $50 to buy the stock. But see, traders don't do that. What happens? They go, oh, I'm going to sell the put. I'm not going to buy the bond. And then when they get assigned, they go, oh my gosh, I'm losing and I got to shut it down, because you're using a mimicking portfolio instead of a replicating. So there's a lot of interesting insights with strategies once you understand the differences between these two formulas. But for right now, and I know it's a lot to take in, it's right now just to show you that there are differences in when we talk about synthetics. All right, so most of the time in the trading world, when we talk about synthetics, we are talking about a mimicking portfolio, and that's why they're not going to balance in terms of their values. So again, hopefully that was some good insights, and if stuff like this is brand new to you, that's a good thing. It shows there's still so much more to learn. We'd like to invite you to take a free 30-minute one-on-one consultation with one of our world-class coaches, absolutely free. So here's the phone number is 888-809-8058. We'd love to have you join us and see how they can help you by giving you more insights. So I hope that was helpful in clearing up some of the problems when we talk about synthetics. Now, tomorrow, I'm going to warn you Thursday for our next tune-up is going to get a little bit technical, but it's also going to be one of the more interesting insights into the synthetics that anybody has probably ever seen. I'm going to show you why a call and a put are exactly the same thing. But for that, you have to wait till Thursday. So I hope you enjoyed it and learned something, and we'll look for you Thursday. Thanks so much, everyone.